Only mode.
Hello everyone, and thank you for coming today. This is Ron Brown, and this is a special day. Gil Morales has offered to join us and talk about how he uses HGSI Investor, and we're going to talk about trading in general also. It won't be all about the software, but this is a tool that he's using now, and he'll explain why he decided to start using this tool and how it benefits him. Anyway, are you on, Gil?
I am.
Great. So do you want to, I'm sure everybody on here knows who you are, but do you want to say a few words about your
Who I am?
who you are?
No, I'm nobody, actually. I'm just a trader like everybody else here, I think, and I trade for a living these days. I used to be a chief market strategist for Bill O'Neill, and I ran money for him at one time. I was also the head of the institutional services department when I was there, which actually was during its heyday in the late 90s, early 2000s, and we advised over, well, close to 700 of the top institutions in the world: mutual funds, hedge funds, bank trusts, pensions, you name it. They were all our clients, and I got a good flavor or a good sense of the flavor of the institutional side of the business in terms of how a lot of these big institutions operate. And so today I'm just a trader, just making a living as a trader, trying to approach it from a very pure angle without really getting involved in running other people's money. I've tried that, and that doesn't really work for me. And just getting back to what I am, at my roots, I made my fortune as a trader, and so I've basically returned to my roots as a trader and also an author. And one of my objectives as a trader is to help other people achieve the success that I've achieved and the lifestyle that I've achieved, because it's a lot of fun when you can just sit home and trade all day. In fact, I was complaining to Ron here. I was going to try and do this on my laptop and use a headset I have on my laptop, but it wasn't sounding very right, so it's very, very good. So I had to come back up to my office here at the house and use another microphone, but I wanted to sit in the backyard and lounge on the lounge chairs while I was doing this, but not to be. Anyways, I got involved with HGSI Investor Software back in 2010, and it's a little bit ironic. When Dr. Chris Ketcher and I were writing our first book, How to Trade Like an O'Neill Disciple or something like that, how we made the billions % in the market, we couldn't use any charts from O'Neill. So they are very proprietary about their stuff, and nobody can use their charts. So we started looking at other things, and there's a fellow named Mike Scott. I think he ran an IBD meetup group for a little while out in the valley, out here in the LA area. And Mike introduced me to HGS Investor as one chart source. In the first book, we eventually ended up using e-signal charts, and most of that was because Mike helped us out in terms of setting up the index charts and the volume and putting that all together and writing all the little programs for that. So we ended up using e-signal charts in the first book. In the next book, however, we decided to go with the HGS Investor charts, and at that point, just messing around with the charts, I realized I liked some of the stuff on here. And what I did is I started using it in, I'm going to say 2013, about May, I would say. I'd started using it more in earnest because I was using some of the indicators, looking at the charts and noticing some things that were helpful. And the fact that I wasn't able to use O'Neill charts in our first book or any of our books, interestingly and ironically, drove me to HGS Investor Software. And I started using that, and over the last 3 years I've been averaging 57.6% a year, and I'm on track to do roughly that this year, knock wood, so far. And I'm not going to tell you that that's all due to using HGS Investor Software alone. I mean, a couple of things that also occurred. I decided to stop running other people's money and to just become a pure trader, and like I said, get back to my roots, and that's been a big part of my success since then. And also just focusing on being a better trader and what goes into that whole process. And so that's basically how I started using HG Investor, and since then I've tweaked it, and these guys have helped out with some ideas we've had. They've been very open to the work of myself and Dr. Chris Ketcher, you know, things like the pocket pivot, the Bible gap up, and other things that I have on my charts or that we like to use. And so we've been working together for a little while, and I'm a pretty much religious user of HGSI now, and I don't use MarketSmith. We still take one Wanda, but Dr. K uses that, and Wanda is O'Neill's institutional product, which I'm not going to tell you it's a bad product, but it's cost $25,000 a year. HGS Investor is going to cost you, what do you guys charge on $6.99, right? Is that what you guys hit my credit card for the other day?
$6.99.
Okay. Um, in any case, that's how I started using it, and now I use it, and it's interesting how your eye acclimates to your data source or your charts or whatever it is you're using, because now I look at a Wanda chart and a MarketSmith chart, and it just looks wrong to me. I don't know why that occurs, but what I like most about this system is that it's very flexible, and you can create all sorts of different chart views, and it's very visual, so I tend to be a visual person. And as you can see from the chart view, they can see my screen, right, Ron?
Yes. Hey, Gil, will you try something? Okay, nothing. It was on my end.
Okay.
I wasn't in full screen mode.
Okay.
Now I'm fine.
Now
It's on my end.
No, wait. Okay. Well, you can see my chart view up here. This is the one, I think, Ron, you helped create this for me, but it's got everything that I use during the day. So this is really the one I use during the day. There's other ones that I think are pretty neat. Some of these other indicators, I'm going to go, whoops. We'll go to another chart here. Let's change the chart view. I always thought Ian came up with some great stuff. Like the high jump chart is an interesting, you see these lines, and basically you want to see on a breakout, you want to see these things continuing higher. And so this can give you some sense of when a stock is extended to the upside when it's not confirming on new highs on the high jump. So I like stuff like that. There's also the volume point of control. What do you call that, Ron? That's an interesting view too. And essentially what I do, my process centers around looking at as many charts as I can. I don't have any magic screen, so I'm sorry to disappoint you if you were hoping to find out about one, but there is no magic screen. There's, I would say, pools of stock that I like, different types of stocks that I like to look at. So for example, a very simple list to use, we'll go to the warehouse here. This is my one of my buy lists. I have a whole bunch of them. But for example, I'll look at let's look at all securities, and then just a filter of you know, price up and ERG over 150. So that's a basic screen, and you know, you're not looking to find 2 or 3 magical stocks that are going to go higher. What it leads you to is a group of stocks that at least based on the criteria, which is I think 30% above average volume. That's all I'm looking at. And an ERG rating greater than 150. An ERG rating to me is comparable to O'Neill's composite rating. So back then I would look at everything 75 or higher, maybe 70 or higher, and I would look at everything. I might cull some things out that traded at, you know, a couple 100,000 shares a day, which is too small, or some other criteria. These days I'm less strict about fundamental numbers, because you'll notice some of the biggest winners have no earnings. Twilio, there's one for you. Square was a great trade earlier in the year, good for about 40% or so, had no earnings. You know, other stocks like Workday and ServiceNow and all the cloud names. Team, I think, is one that maybe hasn't had any earnings. It's done well. So a lot of that doesn't really matter to me. I'm looking more at technicals. And I would say that for the most part, if you're running screens, you're going to look for stocks with 5 quarters up, 20%, you know, return on equity greater than 16%. So you're going to run all this canned sort of data-based screening, looking for particular characteristics, fundamental characteristics. I think you're going to be overlooking a lot of stocks. And so in addition to this screen, I think one of the best screens on this whole system, if there's anything that I might call a magical screen, it is this one here. Uh-oh, we're getting the circular little blue circle. Here we go. Let's see. Come on. Here we go.
You want to go to
smart groups here. Hopefully you guys can see this. And then I go, there's these two brilliant guys, Ian Woodward and Ron Brown. I never met them before, but they're obviously pretty sharp guys. They create this screen, and if you look at this every day, I guarantee you will not miss a big winning stock and particularly if it doesn't fit so-called can-slim characteristics. So I think
Okay,
this is probably my favorite screen. Go ahead, Ron.
that's a smart group for those of you who don't use HGSI. It's what it is. It's a combination of a filter and what we call a combo ranking, and it drives the stocks that are rotating in or staying in to the top of the list, and then we just take the top 100. It's truncated automatically every day, and then that's how I stay, and Gil does too, stays on top of group rotation. Now there's one that is stocks and groups moving to the upside, and just below it there's another one which is stocks in the $1 to $15 range. And the reason for that was when I put these together originally, I was missing all these low-price stocks that were rotating in. For example, earlier this year, the mining stocks, oil stocks, things like that, they wouldn't have shown up immediately like they do in this. And surprisingly enough, there's very little overlap between these two groups. If I make a single group of both of them, I'll end up with about 190 stocks generally. So those two will keep you on top of the market as far as rotation.
What I think is brilliant about this screen is it's not obvious strength. You know, you can look at some sources and they'll show you, you know, stocks up on volume. Well, okay, that's kind of after the fact. But what you'll find here are stocks with improving, what I believe to be improving technicals that are setting up. And you'll see a lot of these in this screen. And so I find it very useful. I think this screen is brilliant, personally. So
thanks.
don't let that get to your head, Ron, okay?
It won't. Don't worry. I'm beyond that. I want you to do something before you move that. I want you to click on the pie chart on the warehouse.
What pie chart? Where's that?
Okay.
Oh, this
right
here?
there. Yes.
Oh, now you're going to make me start getting quanti. Okay.
Oh, okay. Now I want you to click on that drop down and just go up, search up at the top, near the top.
Okay.
Right there, and just type IND in.
I'm sorry,
just type IND, oh, no, D for industry, and then go down to the, right, and just drop down to where it says industry in the center.
Okay.
Okay, click on that, please, right there. And this will show you, out of those 100 stocks, which stocks are appearing in that group. And you can see what dominated it yesterday, the semiconductors, biotech, communication equipment, and so on. So that gives you a visual of the rotation or the strength right there. I use
Ron,
that.
that's a good one to bring up because I actually do use that, but I'll run the filter. Okay, so I'm looking at, I don't know why this suddenly has decided to go slow on me. Here we go. I'll throw up the filter, price of minimum volume, erg over 150, and if I throw that up, now we get a different picture over here. Is that right?
Yes.
Now, if everything that was up on volume, this is going to show me where most of the strength was. So we can see it was in specialty pharma and biotech in terms of stocks that were up on volume. Now, if you go back to the other list, which is stocks moving to the upside, now remember I told you guys that's a much more subtle list. It's not obvious abject strength. It's showing you stocks that are acting positively. Either they're, in a lot of cases they're setting up, or they've had prior strength and they're setting up and pulling back, whatever. But they're acting constructively. And so that, when you look at those two, you're getting a sense of what was strong today using filtering against all securities. You know, what was up big on volume and how does that break down? That's what we're looking at here. But then if you go back to, now to go back to no filter. Let me know if there's any quick ways to do all this stuff, Ron. You know, I would say in a lot of ways I barely skimmed the surface of this program, and that was one of my New Year's resolutions, but it's already, what, September now, so I'm a little bit in trouble there. Well, learn the system a little better and try some other stuff. But go here now. What is this telling you? Okay, this is telling you what may be setting up, what groups are setting up. So we can see biotech is setting up, but also the semiconductors, which were not an area of abject strength today, have been acting well. What's this cream one? Communications equipment. Well, that's like the telecoms, right? Like Acacia, Finisar, other names like that, right, Ron?
Say that again, Gil. I was reading one of the questions. Sorry.
The communications equipment sector was the third.
Yes, if you click on communications on the right-hand side, it highlights the slice. Just click on that on the
Click on
right.
this.
There, yeah,
Okay.
and that highlights your
Oh, I see.
and down at the bottom, Gil, it'll give you the stocks that are in that group. Down at the
There we
bottom,
go.
right there.
Okay, yeah, yeah, yeah. There it is. Yeah. Forgot about that. Yeah, so you got Finisar. Acacia's not showing up in here. But Gigamon, that's been a good one. Infoblox, I think they got bought out today or taken private. But you can see how this leads you right to the stocks in the best groups. And if you're running screens against different lists like I do, it quickly shows me what stocks make up some of the better groups among the lists that I'm looking at. And it might lead you to other names in addition to the ones that you're seeing on the list itself. So anyways, should we get to some questions, Ron?
Sure, sure.
And that we can continue with.
Yeah, I'm going to ask you a few questions, and then we're going to take the audience questions here. Um, Let me see what else. I have a whole bunch of them here, and I can't remember which ones I want to really ask you right now. One thing people have asked about, and I'm curious about, how do you control your risk when you're selecting a stock? Do you position size according to how much money you want to allocate, or how do you do that?
Well, in the old days, I used to go in with 50 to 100% positions just right off the bat. These days, I'm a bit smaller because I think the market's much more volatile, and it's a little bit erratic. I mean, if you guys notice, a lot of the price moves in some of the stocks over the last couple of days on the upside have been gap up moves, and then they kind of fade a bit into the close, and maybe in some cases, like I was watching Twilio today, it gapped up yesterday a little bit and then continued up strongly, and then closed near the lows, and then and so it closed below where it opened up. And then today it did the same thing and it closed down. Volume dried up, so that looks pretty good. Now when I'm looking at a stock, I'm usually buying pullbacks. I'm not buying strength, okay? And you can see Twilio came in towards the 10-day line. That's this magenta moving average. It came towards the 10-day line on very light volume. That was minus 56.5% below average. Here, can I use this pen over here, Ron? Can I borrow your pen?
Yeah, please do.
Okay. You got all kinds of nice colors here. I think I'll take green. So you see right here, minus 56.5%. So that thing's drying up here. Volume is pulling into the 10-day. I'm looking at buying this one tomorrow, possibly, depending on how things play out after the Fed meeting. My thinking is essentially you're going to have two outcomes, right? They're going to do nothing or they're going to raise by a quarter point. If they raise by a quarter point, well, that's probably it, and the market could rally. So I'm going to be watching the stock charts, not trying to come up with some idea that the market is going to react a certain way based on what the Fed does. If the Fed raises 25 basis points, the market could sell off, but then it could rally. Or it could just rally because it's out of the way. Otherwise, if they do nothing, then the market might sell off rather than rally because people might be concerned that it indicates the economy is softer than the Fed has been letting on. So there's a number of permutations, but I think if you look at the individual stocks, you're going to know where to go if you need to go long, and you'll know where to go short if you'd like to go short like I do. And I'll have my ideas ready to go tomorrow. So when I do this and I'm looking at a stock coming in, the first line of defense for me is a 10-day line. So that's only what? How far down is that, Ron, from here? I know how to do this. Hold on. I've got to bring up the data window.
Alternate A.
Where'd it go? Didn't I bring it up?
Try alternate A. Annotation tools.
It's hiding somewhere. Where did it go?
Do you want to measure it from the low? Is that what you're trying to do?
I want to find out where the 10-day line is.
How far it is from the price, you mean?
Yeah, currently. It'll show that on the data window, but I thought if I just clicked on, whoops, there we go, data window. Oh, there it is. Never mind. It was hiding over in the other part of my...
Oh, okay. I thought you wanted the drawing tool. Sorry about that.
The 20-day line is 20-day EMA. That's what I use. 54.79. We closed today at 56.76. So you might get another couple of bucks down to the 10-day line. So I would use a 10-day line as a reference for a quick selling guide if I thought that the market was getting in trouble or the stock was in trouble. Otherwise, the 20-day line, I'm sorry, the 10-day line is at 55.86. So that's about a buck lower, and the 20-day line is about $2 lower. So I can use one or the other of those, but notice how the stock has tended to hold the 20-day line. So I would use the 20-day line as my maximum downside stop, but I keep risk very tight in terms of trying to buy as close to a potential support level as possible and then using that as my selling guide. If I want to use, so let's say if the 10-day line is 2% below where the stock is right now, is that about right? 1.6% below. So if I want to use that plus another 2% of porosity in case it goes through just a little bit, because you know a lot of stocks will go through a moving average briefly and then turn right back above. And that's because the whole world is looking at a particular moving average. That's why one of the reasons I use a 20-day exponential and not the 20-day simple, which is the green one. In any case, that's how I would set my stops. And so in general, I'm looking at 3%, 4%, maybe 5% maximum stops, but I'm also open to being stopped out quickly and then buying back if the stock sets up again. And I may end up buying back a little higher. I don't have a problem with that. I'm not interested. I'm sorry, Ron?
Do you use hard stops, Gil, or just...
No, I just kind of look at how things are acting, and then I just pull a trigger if I think I need to bail, pull the ripcord.
Okay.
Now I forgot what I was going to say.
I didn't mean, I shouldn't have interrupted you.
But in any case, I'm not interested. This was my train of thought. I'm back on the rails. I'm not interested in where okay? I don't care if I just sold a stock and I'm buying it back a little bit higher than I just sold it. What I care about is not where I bought the stock, but where it goes after I buy it, and that's really the key, okay? So I'm going to buy a stock like Twilio, for example, when it's pulling in right here and tight along the 10-day line and volume's drying up. You see no volume down here, so it's drying up and boom, this thing's out of here, and I want to catch that move. And it doesn't matter if I buy here or here or here. Within a buck or two of that, I'm going to catch this move, and that's my objective, is to catch the fat part of the move, and do that with regularity in the various stocks I'm watching while keeping my risk to a minimum.
So what's your trigger right here? Is it the pocket pivots and the price above the...
You can see, you actually have some 5-day pocket pivots. I think this is a 5-day right here, a day ago, and you've got one here, but see, this is actually coming out on a sort of a range breakout, I guess you'd call it, off the top of the trend line. So that's one. That's actually 1, 2, 3, 4. That would be a 5-day. This is also a 5-day. What I look for are clusters of 5-day pocket pivots. So you can see a couple of them together. Here's a couple in here. There's a couple here, but there's nothing else clustering together just yet. But if I see clusters of these, and it's already extended by the time you see this.
Sure.
When I see clusters of these, that catches my eye. And a lot of times when you see a cluster, that can substitute for a standard. When you see a cluster of 5-day pocket pivots, that can substitute for a single 10-day pocket pivot. So that's one of the things that I originally came up with, and then Dr. K has tested that and confirmed that clusters of 5-day pocket pivots can be very positive. So
okay, well that's good. That's good to know. I'm getting a lot of questions here about, do you use options or just buy shares?
I don't use options. So my experience with options is that the premiums, the volatility premiums, can really skew things. And I can remember one example is when I was fully loaded on puts in October of 1997, and that was the day the market went down 500 points at the end. I think it was the 27th of October in 1997. No, 97. It was actually just before I came to work for Bill O'Neill. But I can remember I had options, and when everything broke that one day, my account doubled. The options account I was running doubled. And then the next day, the market bounced a little bit, not the entire amount, but those options basically evaporated, and my account was cut in half. So my account had doubled, and that same amount that I started with was cut in half afterwards because all the premium, the volatility premium, just disappeared. So I think when you're playing high Momo or high momentum stuff, that can be an issue. So I don't claim to be an options expert. If someone is very shrewd about it and understands it and studies it very carefully, then I think that it's a vehicle for riding a trend in a stock, and if you understand how to ride that vehicle and the mechanics of how that particular vehicle works based on different conditions, then I think you can use them, but I don't use them.
Okay. Well, several people asked that question. There must be a lot of options players
But you
out
have
there.
my permission to use options if you know what you're doing, if that's what
If
you're
you
asking.
know what you're doing, and that's the whole key. But you're right about the premium,
Right.
and
I
people
would
have a
hate to think,
tendency to.
Ron, I would hate to think that people would, if I said, yeah, I use options, everybody would run out and start using options. It's a great way to blow up your account.
It is, and people have a tendency to buy them when the premiums are inflated.
Right, and so you have to be much more shrewd about it. And I think buying into weakness, that may be a better option strategy. And to tell you the truth, I haven't really looked into that, because when you're buying into weakness, then you would figure your volatility premiums are going to compress to some extent when things quiet down. Constructive weakness, where something gets tight and the volume dries up and things get very quiet.
Now,
Anyways,
there's a question here about volume. Let's see what the question is. Do you consider low volume, or is there a minimum volume that you're looking for when you're trading a stock?
you mean on the upside for strength?
No, a 50-day average volume. Are
Well,
you
yeah, we
looking?
use 50-day average volume to get a sense of where volume is trading, but I think that looking at the things have to be a certain percentage above the 50-day moving average of volume. To tell you the truth, if you think about it, that's somewhat arbitrary, and it's useful only in a relative sense and in terms of the context of the prior volume. So I've argued at times that you don't even need a moving average of volume. All you can see the relative volume bars on the chart, and they're telling you what's going on. And sometimes if something is picking up volume, but it's below average, but on a relative basis to the prior trading days, that can be constructive. That's what a pocket pivot is all about. It doesn't have to be above average volume. So I wouldn't overemphasize it, although I do use a 50-day moving average of volume as sort of a reference point.
But do you have a minimum volume, like 250 or?
Well, like that one particular filter that I look at every day, it's anything that's up on volume that's greater, 30% or greater above average volume. So if average volume was 1 million shares a day, it would have to trade at 1.3 million shares or more for the day and be up to make that screen.
Okay, is 1 million shares your minimum?
No.
On average.
In terms, well, it breaks down into a couple of things. If you have a $500 stock price that's trading at, trades 200,000 shares a day, then that's, what is that, 100 million in daily dollar volume? It really depends what's the daily dollar volume. To me, if it's 20 or more, then the stock is generally viable. But you can also get a sense of some stocks if you watch them trade. Like I'll give you an example. Some that I've been trading recently, TPI Composites. This thing trades 375,000 shares a day. Now, dollar volume, what is that? About 18, 19 million, Ron? 20 million?
Probably something. I'm not
Yeah.
thinking very
So
well
I don't
today.
have Dr. K with me. He's my human calculator, so I use him for stuff like that. If I ask him, he'll just spit the answer out. Anyways.
We should put a dollar volume field in over there in that
You could
warehouse
put it right
portion.
underneath the 50-day average of volume.
Or you could build it right over there in that warehouse view on the
That's
left.
true. Yeah, you could do that. Yeah, that would work. But the basic idea is for the amount of stock that I would need to buy to have a meaningful position, is the stock liquid enough for me to deal with? So if I have to buy 20 to 50,000 shares of a stock, I can't really trade stocks that trade 200,000 shares a day because I'm going to be a big chunk of the volume. If you have a small account and you're only going to buy 500 shares of something, if it trades 200, 300,000 shares a day, then sure, you can deal with that very easily. So I think it boils down
Sure.
to that. But also these smaller, thinner stocks will tend to be a little wilder. They'll move around a lot more. The other thing to think about is this, and I always measure a stock's say institutional maturity in terms of how interested are institutions in this stock really by the volume it trades. So if institutions are trafficking in a stock and they're interested in building positions, you're going to see the volume in that stock increase over time. I would give you a great example, I think, is let's look at Weibo. This has been one of our
Yeah, it's been
best
a great stock. It's a great
names. But
stock.
you see how if you look down here at the bottom, you can see how the average daily volume is down here. But notice as the stock moves up, it steadily increases. You see that? And so
Hmm.
that's a sign of maturity. So when you start seeing stocks that were trading 400,000 shares a day, suddenly they're trading a million, well, you can pretty much draw the conclusion that institutions are now moving into the stock. So on that basis, it catches my eye in terms of improving volume. So even though I will track stocks that may trade 200 to 400,000 shares a day, and they're small, like Weibo, for example, back when it was 18, 19, 20 dollars a share, I can see when the institutions start getting much more interested in the stock by what happens to the average daily volume. So to me, that's also a key thing to keep an eye on in terms of what I call institutional maturity. Is this stock old enough to go out with an institution or something else? Anyways, you get the idea.
Sure, sure. No, well, the volume's confirming the price here, and the liquidity is increasing. It looks like a great stock.
Yes.
Now, your watch list, Gil.
Yes.
How often do you add to it or subtract or whatever do you do?
Every
Is that
day. Every day
every
I make
day?
a list of, yeah, what's garbage, and you know, like some stocks that were on my watch list have recently come off, and give you some examples. On VOSI, so I run two websites, GilmoreReport.com and virtueofselfishinvesting.com. Gilmore Report I do mainly alone, but with Kevin Martyr, who's one of the founders of MarketWatch, is backing me up on that and dealing with the other aspects of the website. And then on Virtue of Selfish Investing, I work with Dr. Chris Ketcher, who's another O'Neill portfolio manager back in the day when I was there. And so, you know, both websites have their various favorite stocks, and this was one that worked very well for a while on Virtue of Selfish Investing, but it's recently come off because it's broken down. You see the very heavy volume at the peak, and so, you know, on a day like that, that stock would come off if there wasn't some sort of recovery. But you know, every day I'm going through my list and cleaning them up and creating new lists. Because I will save old lists of stocks, because now with Ulta breaking down like this, it can be moved from a long watch list to a short watch list.
Okay,
And you
so
could say
your
it's,
one. I'm
I'm
sorry.
sorry, go ahead.
So your watch lists vary in size.
Oh yeah, if there, you know, a lot of times you can also get a sense of where the market's at. If let's say if my long watch list has 150 stocks on it, that sometimes is telling me that the market's getting a bit long in the tooth on the upside. Because so many things are starting to look good. Conversely, when my long watch list has 15 names on it, then that may be telling me that we're getting towards the end of a pullback because everything's looking like garbage and ready to turn. So that, you know, I keeping track of my lists and maintaining old lists and keeping track of what's on that. That's all part of my daily process in terms of, shall we say, list farming.
Okay.
You got to
Uh,
prune your, you know, prune your fields.
people are asking how many positions do you manage at once? I assume that varies.
Very few, 3 to 5 max. You know, usually I like to run a couple of positions very hard, but in this market, where I used to in the past go to 50 to 100% positions right off the bat, now I'll start with 15, 20, and maybe get up to 30, and maybe 40 depending on how a stock is acting. But a lot of stocks in this market have brief moves, and you have to sell into those. So you either take your position up front uh, in terms of the max you're going to get, because I'm not going to average up for the most part. And so these days, rather than averaging up into a big position like I used to in the old days, I'm trying to take a bigger position at the beginning, but never really getting as big as I would normally. So,
Okay. Well,
but it
here's a
varies. You know, it depends on what I'm seeing. You know, if I'm seeing something fat and juicy, I may go in heavy. But that's not without risk. So.
no. On your Voodoo, there's a question here about your Voodoo. What are you looking for as far as the volume uh, pulling
Well, to me,
back?
Voodoo is extremely low volume. Generally, that's minus 35% below average.
Okay.
but the lower the better. So there's no magical voodoo number that means that if the stock pulled back on minus 35%, it means it's automatically going to go up. What it's just telling you is that voodoo just is a descriptive term that refers to something that's showing volume that's drying up in the extreme. When you have something like Twilio pulling into the 10-day today on volume that's less than half of normal, that's an extreme volume dry up or voodoo. So I mean, it's basically volume dry up, extreme volume dry up. So extreme VDU we used to call it, and then I just changed it to voodoo. It's faster. Sounds cooler too.
Yeah, it does. No question about it. Volume just seemed to dry up in a lot of stocks today. Is that what you saw?
Yeah, I mean, we were talking about this earlier. If I look at, say, let's look at one of my current watch lists, and this is one of the things I like about HGSI too is it's colorful, and I like colors, first of all, and I'm very visual, so colors help me decode what's going on very quickly. So as I was pointing out to Ron, you can look at advanced decline numbers, you can look at this and that indicator, but I can just look at this list. This is my watch list of what I consider leaders or recent leaders. Some of them are correcting a little bit, but for the most part, this is where the action has been recently. And you can see that if we're looking at here, let's see, we've got intraday price change here at the top. So each of the, if it's green, it was up. Now intraday percentage change gives you the percentage change of the price in percent, obviously. And then over here shows me the volume. So if volume was up on the day, this column is going to be green. If this price was up, these two are going to be green, okay? And vice versa. So I can quickly look through this, and let me clean it up a bit here. And quickly look through this, and I'll notice that among all the stocks I had that were up on my list, most of them were up on light volume. So you see the volume is red in this third column here. Let me, if I spread it out a little bit, maybe that makes it easier to see. Okay, and then if I look at what was down on the day, most of what was down on the day, so these two columns, the first two columns are red, and then I can see in the third column the volume change shows me that most of the things on my watch list that were down on lighter volume or below average volume. A few were down on heavy volume, and we can just kind of go through them real quick. GoPro not looking so good over here. You see that nice price break. That was actually looking good for just a brief period of time, but the trade here was off the 200-day line and then up to the top of the range, and you would sell that. But anyways, it broke down. So I can see real quickly what is not a happy camper and what is. Here's one, Riata Pharma. This stock I never bought because it trades 85,000 shares a day, but I did tell a friend about it, and so they would only buy a couple hundred shares. But I picked this one up in here because you can see it's going real tight in here, real tight along the 10-day line. The volume's drying up, and it had a cluster of pocket pivots over here, 5-day pocket pivots as it's coming up off the lows, and then it had a nice move. That was a very nice move instantly. Anyways,
nice rounded bottom.
What's that?
Nice rounded bottom on that one.
Yeah, I think this also showed up on the stocks and groups moving to the upside a couple of months ago or last month, down in here. So that's actually been a good one. But for the most part, okay, you can see visually that if it was up on light volume. For the most part, if it was down on light volume. So not a lot of movement. Percentage-wise, I can quickly see that the biggest mover was this Airgain. And this one I got off of the IPO list on HGSI. If you check that, it's updated, what, every month, Ron? I don't know. When you
No, it's updated every day.
Okay, so you want to check that regularly to have the new IPOs. And this one I think was on there.
Gil,
this thing was up huge, okay, but I can see for the most part the movements are up 2.73% here, down to things that got hit dropped a little bit more. But a couple 3%, that's not out of the ordinary. So for the most part, we can see it was sort of a quiet day, really.
Now somebody asked about this is a view that Gil made. It's not in the views. Gil just modified it.
Yeah, you can create any of these views, and my suggestion would be
actually this view is up at the top, right?
What's that?
This is one of our stock.
it may be your intraday view that, and I may have tweaked it a little bit, but
Yeah,
it's not, it's not hard to do this. All you have to do is go in here and click choose create view. So if you wanted to edit this view, it has the fields over here, and you can just go in here and find different fields that you want to put in there, all over the place, and you can see them. So that you can actually create a lot of different.
Gil,
Yeah.
excuse me, while you're in there, would you edit that again, please?
Uh-oh.
Okay,
Okay.
just edit it. And up there, there's a search field under available columns about a third of the way down, right
Right.
there. Yeah, just type in intra, or you can just go down to intraday. Okay, and
Okay.
there's all your intraday stuff right there.
Right. So you can put all of this, and it'll give you estimated volume.
I use the range a lot, the percent range up near the top, about the fifth one down.
Really? Why is that?
Yeah, because it gives me an instant visual of where the stock is trading on its intraday range. So why don't you add that? And yes,
I think I'll put it.
I put it by the percentage price change, but
Yeah.
wherever. But you
Okay.
you get an instant
There it is,
read.
right there.
You get an instant read about where it closed or where it's trading.
Ah, I see what you're saying. Well, that's useful. Yeah. Wow. Okay.
Yeah, Matt put that in for me, quite a while ago, but it's very helpful. So if you see a stock that's red, for example, on the price, but it's trading at 100% of its range,
Yeah.
it's probably
comes
moving
forward.
up off the bottom.
Yeah. That's very useful. All right. So that works out for me. I learned something new here.
Okay, well, there's a lot of questions. What's the filter for the IPO list? There's no filter. It's in your smart groups. Just look under.
It's under. You go to Smart Groups, click here, and then HGSI Starters.
Starters.
And then
Yes.
popular stock categories and
New issues.
where is it? Yeah, here it is, right there.
I got
Bingo.
it right there. And now you can just take this list that Gil has, or this view, and he can just look at the IPOs and figure out what's up for the day. And look at all those that closed 100% of their daily range.
Yeah. Like, let's see. Oh, these are cheapies though. Atomera. This one I think is interesting. Let's looking at this. But yeah, so it's another list there for you. So I mean, you could spend a whole weekend just going through the lists on here, the smart groups, all the different smart groups. There's so much here, and I don't see how you could really miss anything that's within your field of interest, say, or range of interest, scope of interest, whatever you want to say.
No, I mean, we've pretty much tried to cover everything. Now, you don't use VPA, do you?
Not explicitly. I don't use the flags, mainly because I can see it. So I've already got so many things on my charts as it is, I don't really mess with them. I may eventually, though.
Well, and that's true, and I know you're using VPA, you just don't have it on your charts.
Right, exactly.
Yeah, and I knew that just from watching you. So, but for the newbies and so on, the people that want to learn about the VPA and how well it actually works, it's a great tool. But
yeah,
that's a discussion for another time.
I would say if you're using this, you really need to roll up your sleeves and get your hands dirty and get in there and mess around with it. So, like I said before, I probably skimmed the surface barely, and I'm still able to derive a huge amount of value from it. And again, what I like most about it is that it's not wedded to a particular methodology. It can apply to any methodology. It allows for evolving methodologies. So even though I consider myself a can slim trader in the O'Neill sense, or in the O'Neill style, that's pretty much where my foundation is. But if you think about it, all of that came from Jesse Livermore and Richard Wyckoff, who wrote about Jesse Livermore and that whole this whole sort of philosophy that's expressed in Wyckoff's books, and also what's been written about Livermore and what has been written by Livermore. You'll notice though that Jesse Livermore never talked about having to buy stocks with 5 quarters of earnings up. So
No,
he was very
he was a
oriented
taper.
towards thematic plays. When you go back and read reminiscences of a stock operator, a lot of times he's playing stocks based on thematics. In other words, some sort of theme that he could identify, rather than having some fundamental parameters. So,
Yeah, he was a big group person, group and sector, Like if the rails were moving,
Ron, Jesse Livermore and I worked at the same firm at different
oh,
times, of course, but we both worked at Payne Weber. Did you know that?
no, I did not know that. But that's
And,
good to know. Oh, that's very
uh,
good to know.
I'm just looking at the list of questions that you sent me, and I think I already covered some of the things about scans and the smart groups, cell rules.
Yeah, you do
Uh,
not use scans. You just
I use
go through
filters.
filters but I mean you'll concentrate on the smart groups, the stocks groups moving up. You mentioned the HGS 100 and so on, things like that, and stocks with an ERG above 180. Is that what you said?
I look at that. Well, actually, I think 150, but you could raise. I know Ian used to tell me that 180 or higher was considered the threshold, and I look at 150 because you never know what's going to fall under the radar. And a lot of times these IPOs, it takes a little while for the data to get in there. So I would say if you guys were able to improve anything, it would be getting the data in there sooner, but it probably takes, it's like a 50-day moving average. You're not going to have one on a daily chart of a stock that just started trading 25 days ago. So,
No, the pocket pivots will start working after 10 days, of course, or
yeah. I
5
mean, look at
days.
Airgain. This thing just barely got a 20-day, and it's been, there's no other moving average other than the 10-day and the 20-day. But this thing has followed the 10-day moving average all the way up. And you may notice that you have had, and I think this is the advantage of pocket pivots because there's no real base here. If we look at this on a weekly chart real quick, I love this. Let's just quickly jump here. That's what it looks like. So I don't know about you guys, but I don't see a base in there anywhere. But if you look at the daily chart here, you could see that as you come in here, you finally meet up with the 10-day moving average. The volume on a relative basis is drying up, and then you get a pocket pivot here. So the pocket pivot is cluing you into some strength here, and then you pull back in again, and notice right here at the bottom, you hit the 10-day line and boom, you're out again. So that would be an entry point here based on this strength. So rather than buying into this strength, unless I had picked it up early in the day here, on that day, I would not be into the stock up here. I'd be waiting for the pullback, which you get. This is a very typical sort of setup that you'll see where you can't use standard base breakout rules to buy it. So in fact, in most cases, I wouldn't be using base breakouts to buy stocks. Rarely, if ever. So I mean, look at even if we look at Gigamon, for example, it's been a great stock. It's just trended higher, but it built about a 5-6 week base, I believe, and it broke out here. But what you're going to notice, if you're looking carefully, is that you actually had a pocket pivot here. So you have an early buy signal, but rather than buying that, what I'll do is let it set up and look for a spot in here as it gets tight. You see you get another pocket pivot in here. So now you can enter on the pullback in here into the 10-day and the 50-day lines right in here and get in before the breakout occurs. And then something like this where you're up, what was like a 20% move in 4 days or something like that, I would generally sell at least part of my position into that and then look to buy back on the pullback into the 10-day line. So, but a lot of this gives you a sense here. You can see where you go code blue up here on this pocket pivot, but it doesn't lead to magical upside. But you can see, in general, the situation is improving as you're moving from across from here to here. So, and you go code blue right here on this day, on the breakout, it heads higher. So this indicator can work pretty well when you're seeing something set up real tight and everything turns blue. So it doesn't always work that way. It's not perfect like anything else. for the most part, I just stick to watching the price volume action. So I know people are asking about indicators like MACD or PSAR or Heiken Ashy candles, Heiken Ashy candles, whatever those are. I don't use any of that stuff, but what I would say about indicators in general is I'm not going to poo-poo or slam anybody for using any particular indicator, because I think any indicator can be useful for the individual using it if they understand how it works and how it shifts and changes and how stocks might react to certain looks of that particular indicator. So you might get a good feel for MACD, and if that helps you gauge a stock's price volume action and it works for you, and your eye can pick up the patterns and the movements associated with certain outcomes, and it can work for you. So I think indicators in general, it's really a matter of a person learning to use them and getting familiar with them, and also being sort of a good fit with the indicator. So some indicators for me are just too esoteric. But MACD I think is interesting, and that's probably the only one I use, and I only use that on intraday charts.
Well, everything you do is based upon price and volume and moving
Right.
averages, it looks like. Now, somebody asked, are all your moving averages exponential? They're not, are they, Gil?
The 20-day is exponential. The 10-day is simple. 50-day is simple. I also, on this particular view, you can see a little black line below the blue 50-day. That's a 65-day exponential. So those are, this chart has all of the moving averages I use, but I think I do have one with no 65-day moving. Yeah, here's a more simple view. But the 20-day is exponential. I found that more useful than the 20-day simple. But some people will use an 18-day simple or 22-day exponential or simple, and I think they more or less get you in the ballpark. So.
Okay, somebody asked about the Bongos and Kahunas. The Bongos are essentially an internal relative strength indicator that some HGSI users put together. And the Kahunas, my former partner, who unfortunately passed away a few months ago, came up with the Kahunas, and they're just a big move in the Bollinger Bands, essentially, both up and down.
And they're useful to look at in terms of setting up, because you'll notice here you see some red Kahunas, but some blue ones, but mostly blue in here. And one of the things about, say, Gigamon that's positive is that the Bongo Weekly has stayed blue the whole time. When you start seeing the Bongo Weekly turn red and something is getting extended, that can be a problem. So I think I remember back when Ian was around, I think it was a couple of conferences ago, we were looking at how Tesla was looking pretty grim. This may not have been, let me see this. Might have been on the weekly. Yeah, but when this, I think in this area here, when this started to turn, after a long period of time, it had been blue, and then it turned, maybe it was here. Yeah, I think it was here. I forget, but in any case, when this top one turns red, that can often be a negative sign. I like to see it staying blue, where the daily Bongo can go red for a brief period of time. I also like the bingo bars, which are these gray oversold bars. A lot of times these will tell you when something is at least going to bounce, and it's useful to start to gauge when I want to cover a short position, or if I have something that I'm interested in buying on an undercut and rally type move, to watch for something occurring after you see a bingo bar. So you basically can see on this particular pattern. And I've traded Tesla long. Most of the time, though, I'm buying it on an undercut. So here's it undercuts this low. You get the bingo bar, and it turns and goes, and you get a little run out of it. Now you've done the same thing again here, where you're undercutting this older low here, but not this one. But it's still rallying. So
now the bingo bar is exclusive to HGSI.
Pardon me?
The bingo bar is exclusive to HGSI.
Okay.
That's one of
That's
Ian's
a
terms.
helpful indicator. So when I start seeing at least three, when a stock's been going down for a period of time or in a downtrend for a long period of time, and I see three of these or clusters of three of these, so you see how you have two here and one here, that starts to tell me that the stock may be trying to turn. I think Ambarella was a good example of that recently. Let me pull that up. would have been back in here. Yeah, I see how you saw you had all this cluster of these, and you got this big fat one here, and that pretty much started to bottom it out. Then you got the gap up here, and that was a buy. I actually blogged about that on Gilmore Report, that was a buy at that point. Stocks had a huge run, maybe it's starting to correct. But you can see a lot of these at the lows. You'll see a large number of these and a bunch of clusters. Here you had, it's hard to say, this is like one big cluster, I guess. I don't know. That's pretty ugly. But by the time you start to see this many and you're starting to see some indications of a turn in here, you kind of get a better sense that it may be turning, and you've got some other things to be looking at as well.
Well, and I think there's a screen in there somewhere where if there's a bingo within 10 days and then a pocket pivot following that, that's a signal to take a look at it anyway. And that would have happened right here at the very low on that.
Well, I picked it up right here on the Bible gap up, so that had a nice move. Then it's set up again. You can see along the 20-day line, volume dried up, and then you see you get a cluster of 5-day pocket pivot volume signatures, and this thing just kept going higher. I think it fooled a lot of people, and everybody was short today, I think, at the time as well. So, anyways,
how much room do you give a stock like that to breathe when it's moving up like that? Do you let it come down and test the 20?
Yeah, the 20-day, the 200-day. Once it got above the 200-day, I figured it had to hold the 200-day at least. And here you can see it's set up along the 20-day, and it's pretty much followed the 20-day all the way up. And finally, it's broken below it, and now it's starting to build some more significant base. So it's correcting more significantly and needs to build a base. But it had a heck of a move from here to here. So, and I know a few people who played that move, almost the entire move. And they could still be in the stock, but it's going to need some time, I think, to build a base. But notice how you're starting to see a shift in character, though, in the indicator bars up here at the top of the chart. They're all starting to flash warning signals. And at this top one, the weekly Bongo turned red. That might be a little bit more of a negative, but there's a place to buy it, and that's not your typical O'Neill style buy point. So I mean, I understand now IBD is into bottoming bases, so they've probably been following my work and have finally figured out that in this market, which is highly rotational, you will get movement into beaten down former leaders, and it will be sustained as stocks come back up to their old highs, and then once they get close to a point where they're going to break out, that's the end of the run. So you really have to be looking at stocks within ranges and their movements within those ranges, similar to what the market's been doing for about, more than the last year, since I think last June. Because we've been in a big range, right, since last June, right?
Pretty much.
So
Yeah.
is there a quick way to get to the market? Let's see, if we do this, I guess this does it. As a composite, if we look at this, blow it up, let's shrink it down, you can see that since last June, we've basically been in this big range, and there's been some pretty big moves to the upside and big moves to the downside. And so I think it's highly rotational in the sense that you'll see groups that are beaten down come back to life. Like recently the steels came back to life. They had a little move, and now they've all died. Mm-hmm. And you'll see this consistently where you see stocks coming back. The airlines came back off the February lows, but then they topped and broke down. And now some of them are trying to come back now, I believe. So,
well, they were last week. I haven't followed them lately.
You can look at Hawaiian Airlines, for example. This is a good example. You can see the peak here, and it broke down, but you see how it came off the lows. A lot of these were coming off their lows of February, and they were setting up in these bottoming formations. And you had a pocket pivot here as it came up through the 50-day line right in here. Let me get my pen. Right here. And this is after you had this gap up that failed and you pulled in. So you kind of wash everybody out, volume declines, and you get a pocket pivot move through the 50-day, and that sets off a big run. And it's pretty uniform until it breaks through the 20-day line here. But notice how this was actually a great short too. And then once you get after you're down, you get 1, 2, 3 bingo bars telling you it's oversold. And notice how they get thin, a little fatter, and then really fat. It's kind of like Laurel and Hardy, I guess, or Hardy and Laurel. But in any case, it turns here, and now they're all coming back. So, but that's fairly typical for this market, where you'll see stocks or groups of stocks rise up after being beaten down, and then they'll head up, and they'll have moves, and they'll come back up to some marginal new highs, and then they'll roll over again. And if you're a Can Slim type of base breakout buyer, and that's all you know, which personally I think you time to pull your head out of the sand and understand there are a lot more ways to buy stocks, and they're not that scary. They're very, very workable. I think if you understand the work of Richard Wyckoff and even Jesse Livermore, to Jesse Livermore, a pivotal point was often a reversal point. It wasn't a pivot point, which is O'Neill used that term to refer to a base breakout. And it's much more than that for Livermore. It was, and so I think within the whole framework of what I would call the O'Neill, Wyckoff, Livermore, or OWL (OWL) philosophy, it all fits. And I think you need to broaden your horizons a bit and study the work of Richard Wyckoff and study more of Jesse Livermore's stuff in more detail, not just how it might relate to Can Slim, but also how he traded just on his own and the methods that he had for determining reversals and trends and picking stocks that he felt were going to be big movers. So he certainly wasn't screening for 5 quarters of earnings up 20% or more.
No. Now, do you follow any of the Can Slim rules anymore, like if it's up 25%?
No, not really. No.
Yeah.
A lot of it, to me, conceptually, Can Slim it's basically a template for growth stocks during essentially the post-World War II era in terms of the fundamentals. And during that period, you had money flowing into mutual funds from the public, the investing public, because baby boomers were having to save for retirement. So you had this mass migration of money, and the economy really matured and grew sharply after World War II. So there was this constant production of wealth, which then had to be invested. And more recently, I think we've topped out. And so you don't have necessarily these secular flows of money coming into the market anymore. So the game has changed. I think institutions are trading back and forth and riding certain groups for a while and then bailing out and moving somewhere else, and it's this rotational sort of thing as they try to outperform their bogey or keep up with their bogey. So I think the game has changed a little bit, and I think Can Slim was based on an era that was basically the growth at a reasonable price sort of paradigm, which I don't think is necessarily the case. But I do think that there are big stocks in the market, and from a thematic standpoint, they're very playable on that basis. So names that come to mind that didn't fit Can Slim when they started. Tesla is a great example. A lot of these social networking names, LinkedIn didn't necessarily have great characteristics right away, but there are big stocks and they will have some of the characteristics, so I think some of it is relevant in that sense. But in the past where big earnings growth would help identify a big leading stock, these days I think technicals and the thematic sort of aspect there, where they have to be owned by institutions. So you get a name like Tesla has a big move even though it doesn't have all the earnings. Solar City was another one that had great moves. And I remember I found both of those initially on the stocks moving to the upside screen, as I recall.
Oh, you did?
So, yeah, so I mean, Can Slim has its relevance to some extent, but I wouldn't get stuck in it. And I would also think in terms of the big stock principle. What is a big stock? What is a thematically powerful sort of situation? Like I think Twilio is very interesting. Acacia is more of a Can Slim type stock, but I don't think it had 5 or 6 earnings of big growth. I think it had starting to show some reasonable earnings acceleration. One of the things Dr. K has identified is this sort of rapid earnings acceleration, and a lot of times it can be from deep losses to smaller losses to small gains, and so it's more this sort of rapid ramping up that can take place in some of these names. So that's the sort of thing we look for.
Let's go through a few of these questions and then we'll wrap this up. You want to get outside and sit by the pool, right?
Uh,
Uh,
yeah, whatever. That's fine.
well, no, you're doing a
Going
great job.
anywhere.
I'm in no hurry. I mean, we can go for a little while. I just want to see is okay.
I can
How'd
go
you?
to like another 20 minutes. That'll work.
Okay. How did you locate Twilio as a potential trade? Did that come up in the IPO list?
Yeah, that came from the IPO list. And then what I'll do is when I looked at, I mean, Twilio, I knew, well, you knew about that one from the time it came out because that was kind of a hot IPO, and it acted pretty well right away. But you'll notice that it did set up here along. I'm going to have to blow this up. Let's see. Here we go. Okay, let's get my pen here. It's set up along here. When I first noticed it, it was setting up really nice and tight along the 10-day. Then notice how you had this undercut of the prior low. So that sets up the undercut and rally. And as you come out the top, now you get a pocket pivot in here. And then on the day of earnings, it sort of stalled out, but it held up really tight. So I actually went in heavy after this one here, and you get a very nice 4-day move out of it. But that originally showed up on my watch list off of the IPO list. So and same thing with the line. Corporation, LN, Airgain, a couple of the others would be like that have had recent, have pretty good moves recently, but they've some of them have died. YRD was one of them. If anybody remembers that, that was a nice move. A little bit of thin
Yes.
stock. Urandai, but that showed up there originally when it was down here, as a nothing, and that rapidly became a nice mover. But that was a recent IPO way back here. So it came out, I think I first found it like in here when it had come public down way over here on the left side, and just as it was rounding around, notice how it went code blue up off the bottom, all these indicators turned blue. So that started to catch my eye right along there. And then it had just a fantastic move, a nutty move in fact, and it had several spots where it's set up within the pattern. So that was a very nice stock to find. Some other ones, Square was a good one as well that showed up there first. But notice how this formed a cup with handle, and then the buy point was in here, right along the 12 area, and it had a big move, very quick 30% or so move. I think it was 40%, something like that, from here up to the peak. And now maybe it's trying to set up again, just kind of watching it now. It's had some gap ups, but it really hasn't gone anywhere. So.
Okay. These are all IPOs.
Recent IPOs, yeah, it's really been a new merchandise market because if you look at the indexes, Ron, they really haven't gone anywhere since late July. And in the meantime, though, you've had some very, shall I say, festive price moves in stocks like Acacia. So I can remember people emailing me at the end of July and saying, well, I'm taking a break from the market, I'm not going to watch anything for a while. And that's right when a lot of these opportunities showed up, even as the market itself, the indexes were going nowhere. And I think it's a really stupid thing to say, oh, I'm going to take a break from the market. You don't have to take a break from the market. You can spend a few minutes every night. You watch TV every day, or you brush your teeth every day, and a few other things that you have to do every day. So why not take a quick look at the market and see what's moving?
That's
So I think
true.
at the very least, on a daily basis, whether I wanted to be involved in the market at any particular time, I would be looking at that stocks moving to the upside list at the very least every day. It's 100 charts. You go through that, and you're going to be on top of what's moving in the market, and you won't miss any opportunities. But just this idea that, I'm going to take a break, and it's interesting that I got a lot of emails like that right at that time, just before all these names started running. So I think Line,
They
there's,
were asking for your permission, Gil.
what's that?
They must have been asking for your permission to leave the market. I mean, I
Maybe,
wouldn't
I don't know. That
I
would be a
wouldn't
dumb.
notify anybody.
Well, I would tell anybody, if you're an investor, opportunities are going to happen when you least expect them.
Oh,
I
sure.
always tell the story of 1999, and it was the end of October, okay? We had a little over 2 months left in the year, and it's like October 23rd, and I tell the story in the first book that we wrote, Trade Like an O'Neill Disciple, that Bill O'Neill says, he calls me up and says, this market is through, this is it. And we were pretty frustrated at the time, but I was up 32% in my own account on October 23rd, 1999. And 4 days later, on October 27th, we had a follow-through day, and we just went in and bought stocks. We had no idea that, oh, we're taking a break from the market. But I went from 32% at the end of October to up 1,001% at the end of December. So in a little over 2
Wow.
months, the amount of money I made was amazing. It was life-changing, okay? And just a few days before that, Bill O'Neill, the great Bill O'Neill, and I'm not saying this to take away any of that, but even Bill was thinking this market stinks. So, you know, even nobody, even the best traders, the greatest investors of all time, they're not going to see it when it before it happens. So they're not going to be able to tell you, yes, I think between November and December of 1999, that's when we're going to make all our money. So we'll take the, you know, before that we'll take the year off up until the end of October. Nobody saw it coming. Nobody knew the size of the opportunity before it happened. There was no way to measure that. I know there are some guys out there who've been trying to study follow-through days to figure out the optimal follow-through day. And I got to tell you, I think that's bunk.
Yeah,
There is no such thing as an optimal follow-through day. The wave comes, you jump on it. It may turn out to be a big one, it may turn out to be a small one, but you just jump on it. And the idea that you can tell beforehand that it's going to be of a certain magnitude is just utter nonsense. So the bottom line is you got to stay on top of the market. You need a tool that's going to keep you apprised of what's looking good in the market and where opportunities might lie. All the time, not just when you think, you know, you're going to take a break or you're going to be involved, because the market doesn't really know that you're taking a break. So
no, and if you're right, if you look at those stocks and groups moving up and down, if you're interested in shorts, I mean, those will keep
right,
you on abreast of the market. I
right,
mean, you know, I do a lot more than that every day, but that's really all you need to do. Let me get through a few more of these questions. Gwen asks, how often have you had a sudden pre-market open news announcement and your stock gets hit? What do you do? Do you sell at the open, or do you see what happens? Do you see how the market responds to it? What do you do in that
it
situation?
really depends on what's going on and where the stock is and what my cushion is, if any. So if I think it's really bad, I'll just bail out. But there's no specific set of signals that I might use one way or the other. A lot of times, though, if you do get a break on the opening, sometimes if it's news related, you'll sit and see if your stock is able to come back. But you do have to have a maximum out point, because you're not going to sit there and lose huge money.
No, no.
And you could see that, like last August, if you sat too long and just kind of waited, you'd be down big pretty quick. So you do have to have your out points. But there is no magic way to deal with that sort of uncertainty. That's part of the market. So the trick is, if you're losing money, to make sure you don't lose too much money and that you live to fight another day. But I would not say that I have any specific way of dealing with something like that. You know, judgment is a big part of it. And Richard Wyckoff wrote, you know, some people, when someone asked me, you know, what are, if you had one piece of advice for active traders, what would it be? And I said, well, you know, make sure you have a good set of quote monitors. How's that? But I suppose if I had to answer that question in a non-facetious manner, I would say that you need to spend the time to develop your judgment and to be able to exercise judgment and train your mind to deal with the data flow that's coming at you from the tape. You know, the way Livermore dealt with the tape, now we're dealing with the screen, and it's a much different situation, but it's the same information coming across at you. And experience will give you a sense of movements and what they may or may not mean. And I think that people too often are goaded into believing that investing is as easy as 1, 2, 3. That's a pile of baloney. It's not. It's very difficult, and these days it's even more difficult. So any edge you can gain, I think, is helpful. But you have to spend that time, screen time, either studying charts and going through charts every evening if you have a day job, or preferably being able to watch the markets trade during the day and how they react to certain things, and the themes and sub-themes and subplots that are all running through the market at any given point in time, and being able to, say, subconsciously assimilate all that into your judgment and developing that over time. and also trading with no emotion. This is something Wyckoff talks about in his books, I think Stock Market Technique #1 and 2. And then there's a book, Studies in Tape Reading by Rollo Tape. That was Richard Wyckoff's
Mm-hmm. Yeah,
uh,
that's
nom de
free.
plume or pen name. Yeah, and great book. But he talks about how people think that they can. Like even O'Neill says this, but O'Neill put it a little bit differently. He probably got the idea from Wyckoff when he says that let me see if I can just find this real quickly. Mental qualifications. Uh, Why would somebody who believes that they need to spend hours and years preparing to be a doctor or a lawyer or any other profession and to be good at it and make money at it, they understand they have to spend a lot of time learning and perfecting their craft. Why do they think that they don't have to do that when it comes to the stock market? And you find that, I think the stock market in general is ripe for con artists, who are trying to sell people on this or that magic system, and spend $15,000 and come to our weekend webinar, and we'll certify you and all this other stuff. Like it's gonna automatically lead to big riches. I think that's not true. That all of that's just a phony thing with which people can exploit other people and make money off of them by charging them for all this stuff that really doesn't help them. Because the number one thing that's going to help anybody is their own experience trading and the time that they put into it themselves. So I think to get a basic idea of philosophy, I definitely would recommend reading Stock Market Technique #1 and 2 by Richard Wyckoff, and also Studies in Tape Reading. I think to me, and remember Richard Wyckoff started the magazine of Wall Street, so it was called the Magazine of Wall Street, I believe. Is that right, Ron?
That's right, and he had 200,000 subscribers back in the
Right.
20s, if you can believe
And
that.
he interviewed Livermore, and all of that stuff comes from Wyckoff and Livermore. So all the stuff that O'Neill has taught and talked about, all the stories, even the red dress story, that comes from a day trading book that Richard Wyckoff wrote. But it's all part of that whole philosophy, and I think the main part of it that comes through to me is the idea that you have to develop your own judgment, and that only comes with time and effort. And if you're not willing to put in either, then go away, get out of here.
Yeah, and you have to play with real money too, or you
Yeah.
will not. It doesn't matter. I mean, you have to experience the emotional aspect of it.
And eventually learn to not have any emotions.
Right.
I think one of the things that the areas where I've made the most progress over the last few years has been in having no reaction to what the market does. It's just doing what it's doing, and I just trade based on what I'm seeing rather than what I think it should be doing, and also not in reaction to an emotion. And I think when you get to that point, you're making some progress as a trader, because once you can think clearly and see exactly what's going on without having any sort of bias or emotional cyclone in your brain working at the time, then I think you're able to actually see what's happening in the market. And as I told Ron with the HGS Investor, it helps me to see what's going on a little more clearly. So it all jives with that whole concept, and where I'm at in my 26th, 27th year, I don't know, I lost count, as a trader, and someone who considers himself a pure trader rather than somebody who's trying to market expensive webinars and seminars and courses and whatnot to
Indicators.
people. Magic indicators, yeah.
Yeah, they don't work.
Magic software systems. And the prices people charge are ludicrous,
It all comes down to tape readings, what you're saying, and
pretty much.
it goes back 100 years,
Yeah.
or more. So there's really not much new. It's just learning to apply.
Right, and understanding that environments are a little bit different. So you're basically applying the same set of principles to changing markets, and you need to tweak those. If you get too rigid and you're getting negative feedback in that, okay, if you're buying breakouts and they're not working and you're getting hit for losses, then the intelligent person would react to that and make an adjustment and figure out something different. The idiot will sit there and beat their head against a rock until their head splits wide open because rock isn't. And people will do that. So, and especially if they've been led down some primrose path that this is the magic way, and we can teach it to you for $14,000.
No, well, you know.
That's one other thing I always liked about you guys, you and Ian, Ron, is that you put on a 3-day workshop, and for 3 days, I don't know, was it $1,300 or something like that?
$12.50, $12.95.
Yeah, and so I always felt that you guys were trying to provide value to the average investor, because let's face it, the average investor, they're lucky if they have $15,000 in their account, much less $15,000 to go spend on a weekend seminar, which I think is just baloney. So, and I really think everybody has the ability within them. I mean, there are a lot of people I think who try and invest, but they're really not cut out for it. And it's helpful if you can reach that conclusion sooner rather than later, because it'll be a lot less expensive. But I think a lot of people do have the basics to become very good traders, and they need to believe that they can do it. And I think a lot of people, a lot of the charlatans selling stuff on Wall Street want to create dependency rather than allowing people to be empowered and independent in their decision making, and their ability also to understand the markets and recognize what works and what doesn't at any given point in time. So,
well, there's a bunch of questions there. Let's see if I can get through some of these quickly. We've only got 10 minutes to go. 5 minutes, okay.
Yeah.
Have you ever held a stock for 6 months without selling it and getting back in? Is a question, something to that effect. Do you have any long-term holds?
6 months? I don't think I've ever held one 6 months. 3 months probably tops.
Okay.
But if you look at the biggest moves in leading stocks, that's probably the extent of them. These days I think they're much shorter, maybe 2 to 3 weeks. I mean, look at the move in Acacia recently, okay? Do I need to buy that and then sit through it the whole, for the next several weeks as it goes up and down 20%? Who knows if it's eventually going to break down, if the market breaks down. I would rather be extracting the fat part of the move and then backing away, taking profits, and then waiting for the next setup. And even with a stock like Weibo, you know what, Ron, I'm going to go here. Even with a stock like a WB, if you look at it, my HGSI started updating, so I'm going to let it do that.
Fine.
But let's see if I can get this chart to come up. Uh-oh. I mean, if you look at Weibo, for example, that thing has had a long move. So you guys pull it up on your own. I can't seem to get it to come up right now. I don't know what's going on here. But if you look at it, you'll see that it has these moves up, and it runs up, 20, 25%, and then it backs in and it forms another base. And you could sell into the big move and then buy back when it starts to flatten out and the volume dries up. So if you study that chart, you can see what I'm talking about. And that's the case for most leaders. And I think you have to do that more in this market, because they will pull the rug out on you in a hurry. So you can see here, for example, here's a nice pocket pivot. This is what got this whole thing started. And it runs up, about 20, 25%. You could sell into that. Now it steps up again. It gets real tight right in here. And this is actually where I was all over this thing. Right in there, you can see the volume drying up. So right in there has another move up, and that's about from 24 to 28. That's another 20% or so, maybe a little less, a little more. And then it pulls in, and now you undercut this low right here, and you set up an undercut and rally, and you set up and go again. And now the stock is just basing. So even though it's had this long move, it has. Here you get a little more pronounced move. Now, one of the things is as you get several of these, you start to move like this. You can use a 10-day moving average as your stop, because what it's starting to do is get parabolic. You notice how you run up, you base, you run up, you base, and finally you come out and you start to have a parabolic type of move. So you want to try and capture most of this, and using either the 10-day or the 20-day as a selling guide would probably be your best bet once it starts to accelerate like that. Okay, so you don't necessarily have to sell into it if it starts to really move, and you can get the sense of it here when it starts to streak higher in heavy volume. and as long as it's able to hold up and hold the 10-day line, you're probably okay. So that's one way to handle these when they do start moving, and you don't see it start to falter, and the move becomes a little more powerful. So, but you know, I'm quite willing to buy a stock back after I sell it, even a buck or two higher if I think it's going to keep moving.
Sure.
So it doesn't really bother me. But the idea that you need to hold stocks for years, if that's what turns you on, you know, and makes your leg tingle, then go for it. You know, that's not the way I play, and that's not the way I've made big
No,
money. I've
you've been,
held leaders for probably 3 months at the most. I don't know if I've ever held anything 6 months, and I extract the biggest part of the gain out of it. So, but if you know, you can be like my friend who bought 250 shares of Apple back in 1984 at 24 and watched it go down to single digits, and then eventually came back up, and now he's happy. But it, you know, that's more lucky than anything. So.
okay, let's do a couple more. What are your thoughts on Darvis?
My thoughts on Darvis is a good book. So, I mean, he's basically identifying bases, you know, before O'Neill did. So.
Okay, here's one from Stephanie. Just a comment for Gil. I have loved listening to you for years. You are like a trusted friend.
Thank
That's
you.
for
I
you, Gil.
appreciate that. I'm happy to be a trusted friend anytime.
Do you
But, you
set
know,
alert?
my view is if I can help people understand the market and understand themselves and become empowered to deal with the market on their own terms, using their own head, then I've achieved my goal. So.
Okay, once again, the books you recommended, Studies in Tape Reading.
My Rollo tape, R-O-L-L-O tape,
Right,
with
that.
Richard Wyckoff. Stock
And then
Market Technique 1 and 2.
I've got that right here in my hand. You can buy these on from Amazon. They're thin books that were written back in the 20s and 30s.
Yeah,
And
so they're a little quaint. You know, they're a little bit quaint in terms of talking about stocks at 3/4 and 5/8 and this and that. But I think a lot of the underlying philosophy is very useful, and it kind of brings you back to basics, I think. Also, I like Anna Cooling's book, Price Volume Analysis. What is that?
Yeah, that's it. Well, yeah,
Yeah, and
it's
then there's another one by, I think the guy's name is Mark Weiss, Trade's About to Happen. He's another Wyckoff.
yeah, that's a tough book to get through.
It's pretty thick, but I think it gives you a lot of the basics of some of the alternative setups that you can use in this market. So I love using undercut and rally type moves. You know, I mean, look at some of these things. Like this is an amazing one to look at. Silicon Motion. Look at this thing. This had a very nice price move, and notice how there is a point where it gets, you know, it's very steady on the upside, and there is a point where it gets a little bit parabolic, right? And that's when it starts to base build. But notice how it undercuts this low here. Looks like death, right? Big volume, heavy selling volume. It looks like it's headed for the 200-day line. But it undercuts this low, turns around and rallies, breaks out marginally, and then comes apart now. But that's a nice trade. If you catch this from, say, 49, 50 up to, say, 55, 56, that's a 10% trade in just a few days. You can catch stuff that's not too bad.
It's just a much lower risk trade getting in down below there.
Right, exactly, and that's a Wyckoff. I think it's a spring, Wyckoff spring or springboard.
Spring.
Yeah, and you know I call it an undercut and rally, but it's basically a Wyckoff spring, and it is a type of setup that works, and it seems to work in this market very well. So, anyways, I think I better wrap it up.
Okay, well, we didn't get to everything. I'm sorry we didn't, but we covered a lot of it. Maybe we'll do this again sometime. If you're interested, Gil,
Sure.
we certainly appreciate it, and we appreciate you using the software and
I appreciate you using the software.
well, good. Someday, if you ever
The
want,
IRS appreciates me using the software.
well, that's really great. If you ever want me to show you some of the stuff I'm working on, I'd be happy to. But
Okay, we'll have to schedule some time for that. So.
yeah, you're a busy man. Anyway, thank you very much.
Sure.
Thank you, Gil.
And
Good thing, George. My pleasure. How do I get out of here now?